Yes, my dear students, the series of Group 1 Accounting Standard, in which we have Accounting Standard 16, borrowing cost. A very small standard, the objective, the definition, components of borrowing cost, start, that is commence. I'll just add up something. Types of borrowing. And the last area, commence, suspend, and cease capitalization. Now friends, see what is this standard all about. Basically, the whole purpose of this standard, I can say, is only two things. Is when to capitalize borrowing cost and when to expense of borrowing cost. When to capitalize, when should we add this borrowing cost to my asset account, and when should I expense of the borrowing cost, means it will be debited to profit or loss account. This is what the standard talks about, and based on that the definition is there. What is borrowing cost? So it says borrowing cost is interest cost and other cost which are related to directly attributable to construction, production, and acquisition of qualifying asset. These are those costs which will be capitalized. Means the borrowing cost is nothing but our interest cost. So you paid interest, you have taken a loan, so you paid interest, and some other cost that I will be discussing when we do components of borrowing cost. These have been incurred. Why? They are directly attributable to why? Construction, production, and acquisition. Three things. They are attributable to construction or production, or you are acquiring which asset? A qualifying asset. So obviously question arises, what do you mean by a qualifying asset? I'll just use the word QA now for qualifying asset. Qualifying asset is an asset which necessarily takes substantial period of time to get ready for its intended use or sale. So a qualifying asset is an asset which necessarily, means it is part and parcel of that asset. That period is very much important. So qualifying asset is an asset which necessarily takes substantial period of time to get ready for its intended use or for sale. So in order to bring that asset in working condition, this substantial period will be there. Or in order to bring that asset in saleable condition, this substantial period will be there. So qualifying asset is an asset which necessarily takes substantial period of time to get ready for its intended use or sale. So again, the next doubt comes, what is substantial period? Generally, see, it is not compulsory. Substantial period is generally a period of 12 months. So if any item takes 12 months to be ready for intended use or to be ready for sale, then we say that item is a qualifying asset. But it is generally, it means it is industry specific. Many a times, a period of less than 12 months can also be considered as substantial period of time. So this is not a yardstick. Huh? So even 7 to 8 months have been considered as substantial period of time. Of course, for examination point of view, we should just write a note if we are assuming that period to be a substantial period. Now, proceeding further, friends, this is our definition part. What are the components of borrowing, in which one of the component is very important, and I'll be solving that part. One example is there in our textbook. Component of borrowing cost. See, borrowing cost is interest cost. So that is very simple for us. That whatever interest I pay, that is my borrowing cost. Yes, my dear students, that is very simple stuff. But it is not only interest. It is other cost also. What are those other costs? So those other costs, this is what we have to define. Nothing but discount or premium in relation to borrowing. Means we have issued debentures which are issued at discount, or the debentures will be redeemed at premium. So this discount or premium in relation to borrowing is there. Incidental charges like processing fees, stamp duty, commission given to some person. This is also part of my other cost. The last and very, very important, because this is where the confusion comes. So not last, there are two more, but I'm just revising, so I'm just going for some important of them, and that is exchange rate fluctuations. To the extent they are regarded as adjustment to borrowing cost. Exchange rate fluctuations, to the extent they are regarded as adjustment to borrowing cost. Now what does it mean? This is exception in AS 11, but here it is considered. Generally referred as para 4E. Now see, what is this? It says whatever is your exchange fluctuations, which is part of your borrowing cost, that much of exchange fluctuations will be considered as borrowing cost. Like, let me just give a small example to complete of this. Say I borrowed $10,000. Interest rate, say 7%. Exchange rate beginning, say 60, beginning of year, at end, say it is 63. $1 is 63. Yeah? Interest rate in our country, Bharat, is a 10%. So now, my dear, what is happening is you have exchange fluctuations. What is the quantum of your exchange fluctuations? What is the exchange fluctuations you are going to have? Can I say it will be $10,000 into 3 rupees, 30,000? How did I get? 60 will become 63 at the end of the year. The loan is not yet paid. It is not yet settled. I will translate it at a closing rate. So 60 will become 63. So that is nothing but 30,000. Now the standard says, out of this 30,000, this exchange rate fluctuation, something should be regarded as borrowing cost, which will be covered by AS 16, and the other part will be regarded as exchange fluctuations, which will be covered by AS 11. Now, how much is borrowing cost? So it says very much simple, to the extent it is regarded as adjustment to borrowing cost. So friends, it's nothing but, had I borrowed in our country, I would have paid the loan based on what amount of interest. So I'll say, sir, 10,000 into 60 means the loan amount is 6 lakhs. On that, 10% interest would have been paid. So I would have paid 60,000 as interest had I borrowed interest if borrowed in our country. So we would have paid interest of 60,000. What is the actual interest paid by you? Because you haven't borrowed in our country. You're borrowing from outside. You borrowed it from, say, US, $10,000. So what is the actual interest paid by you? Can I say it will be 10,000 into 7%, and when you pay it is 63, because you don't pay at the beginning of the year. So you paid how much? 44,100. This is the amount you pay. So now what happens? 60,000 and 44,100. Nothing but 15,900. This is the interest differences if we borrow in India and if we borrow from outside India. That of course in foreign currency. Here remember, it should be 63 because actual payment is not based on 60. Had you borrowed in India, you would have borrowed at 60 rupees only. Na? The amount of loan would have been 6 lakhs. But in foreign currency, the loan is 10,000. So to the extent of 15,900, I will treat this as borrowing cost. Means 15,900 will be borrowing cost and 14,100 will be nothing but exchange fluctuations. Okay. So this is what the stuff is. This is our borrowing cost and this is our exchange fluctuations. Pertaining to this, there is a example there in our homework section. Yeah, the Shah Builders has borrowed a sum of US dollars 10 lakh at the beginning of the financial year 14-15 for its residential project at LIBOR plus 3%. LIBOR plus 3%. So can I say it's nothing but London interbank offer rate plus 3%. So whatever is the London bank rate plus 3% I will give. The interest is payable at the end of the financial year. At the time of availment, the exchange rate was 56 per US dollar and at the end the rate is 62. If Shah Builders Limited borrowed the loan in India in Indian rupees, the pricing of the loan will be 10.5%, 10.50%. Compute borrowing cost and exchange difference for the year ending on 31st March 15 as per applicable accounting standard. Applicable LIBOR is 1%. So London interbank offer rate is 1%. So my interest rate is 4%, can I say? And our India's interest rate is 10.50%. I have borrowed how much? 10 lakh dollars. So first of all, I have to find out, had I borrowed this in India, what would be the actual interest I would have paid? And then compare it with the interest what I am actually paying. You should just do this. Interest borrowed in India, interest actually paid, you will get difference. These are the difference. And then whatever is the exchange fluctuations, to the extent of difference, it will be regarded as borrowing cost. Anything extra over and above it will be regarded as exchange fluctuations. So see, your increase in liability is 60 lakhs. Increase in liability, that is nothing but exchange fluctuation, is 60 lakhs. If you borrowed in India, then you would have paid 5880. So 5880 minus actual interest, that is 2480. My dear students, what you get is nothing but 34. So out of 60 lakhs, 34 lakhs is borrowing cost. Remaining amount, that is 26, will be considered as exchange rate fluctuations. Okay, so you can just have a glance over the solution, and this is what a good stuff. Point number 3, homework section, point number 3. Okay, my dear students, let's proceed further. This is components of borrowing cost. Now comes types of borrowing. Two parts: specific borrowing, the other is general borrowing. In case of specific borrowing, what are you supposed to do? In case of a specific borrowing, what am I supposed to do? Remember, whatever is the borrowing cost incurred minus income from temporary investments, this will be nothing but borrowing cost to be capitalized in case of specific borrowing. If it is specific borrowing, so whatever is the borrowing cost incurred minus income from temporary investments, this will be the borrowing cost that has to be capitalized. This is the amount that I will be capitalizing. Now comes general borrowing. See, specific means what? If you look properly, I have taken a loan and that loan is specifically for a particular asset, say this asset. This is specific borrowing. General borrowing means what? Nothing but I have taken a loan and this loan is for general assets, which may be qualifying and non-qualifying assets. Yeah. In case of general borrowing, we need to capitalize borrowing cost based on weighted average rate. In case of general borrowing, we need to capitalize borrowing cost based on weighted average rate. Whatever is the weighted average rate, based on that we have to capitalize the borrowing cost. Like say for example, I borrowed 20 lakhs and this have been used for say qualifying asset 10 lakhs, working capital 3 lakhs, others say 7 lakhs. So here what I can do is nothing but the weighted average rate is 12% only, because a single loan is there. Multiple loans will be there, then obviously the rate will differ. So as far as our ICI is concerned, it gives an answer in this way: the 20 into 12, that is nothing but 2.4 lakhs is your borrowing cost. So 2.4 into 10 by 20 ratio, I'll do ratio 10 by 20, that will be capitalized. 2.4 into 3 by 20, that is pertaining to working capital, this will be expense of. And 2.4 into 7 by 20, this will also be expense of. Yeah, this is what are we supposed to do. So this will be capitalized because it's for a qualifying asset. So what we do is nothing but we are taking a weighted average rate, that this amount has been utilized for all purposes. So two types of borrowing, specific borrowing and general borrowing. Specific borrowing, whatever borrowing cost is incurred, full capitalize. General borrowing, it will be based on the interest rate applied on the qualifying asset. That is the best option, or you can say in the ratio. Now, three things which I'll just speak up orally: commence, suspend, and stop, or I can say cease. Commence, three conditions to be fulfilled. Number one, capital expenditure in relation to qualifying asset is being incurred. Number two, borrowing cost is being incurred. And number three, the activities to prepare asset are in progress. If activities are not happening, they are not in progress, then no need to start with capitalization. Activities include physical, technical, and all those things also. Suspend capitalization. When should we suspend capitalization, friends? We should suspend capitalization when the activities to prepare the qualifying asset are suspended due to abnormal reasons. Then during that period of suspension, whatever borrowing cost is incurred should be expensed off, should be transferred to P&L. Like from the month of June till the month of September, due to pandemic, on account of Chinese virus, I was not able to do business. Then what should I do? This is suspended. Work is suspended. I was not able to do construction activity. So this period interest will not be added to the cost of the asset. It will be debited to P&L. Cease. Cease means stop capitalization. Stop capitalization. When the activities to prepare qualifying asset are substantially over. When can I say the activities are substantially over? 90% and more. The asset is ready for intended use or sale. Stop capitalization. Okay, so this is what the standard talks about. Yes, my dear students, you can just have a glance through the whole standard. Of course, class 4 questions which you have already done. Borrowing cost, in which this was very important area which I discussed with you. These are other things also. Qualifying asset, borrowing cost, capitalize. Other borrowing cost, expensed off. Specific borrowing, general borrowing. ICDs, you will be having that doubt. What is ICDs? Intercorporate deposits, that are referred as ICDs. Yeah. Of course, borrowing cost which you capitalize should not exceed the actual borrowing cost incurred. Commence, suspend, and thereafter cease capitalization. Stop. Okay, friends. Within homework section, I have already completed point number 3. It was nothing but para 4E. Question number 4. I'm doing this question purposefully. The reason is you are having a doubt because somewhere in module this point or past papers, once upon a time advance for purchase of truck was considered as qualifying asset. In other question it was considered as not a qualifying asset. I would prefer advance for purchase of truck not to be considered as a qualifying asset because it does not take substantial period of time. So we have taken a loan of 70 lakhs for factory shed, for purchase of machinery, for working capital, and for advance of payment of truck. Can I say this is qualifying asset? These are not. Means to the extent of 25/70, whatever borrowing cost I'm incurring, yeah, this should be capitalized. So total interest is 9,10,000. So this 9,10,000 into 25/70, this will be capitalized and the remaining amount will be expensed off. Yeah, 9 lakh into 25/70, this will be amount capitalized and remaining amount will be expensed off because it is not a qualifying asset. Please, this is correct. Here also, it's on the same way. Yeah, you've taken a loan from 70 lakhs to be utilized as under. See, this truck is not a qualifying asset. Hence, the answer is 4.8. How did I get 4.8? So 28. So can I say it will be nothing but 12 lakhs into 28 by 70. 12 lakhs is my interest. 4.8, and remaining amount is getting expense of. Your presentation has to be the same way what we did. Particulars, amount to be capitalized, amount to be expense of, and total. I'll do just discuss this area. Question 6, and then we stop. On 15th April, RBM obtained a term loan from bank for 320 lakhs to be utilized as under construction of factory shed, qualifying asset. It takes substantial period of time. Not a qualifying asset. Not a qualifying asset. Not a qualifying asset. This is also not a qualifying asset. Advance is not purchased. This is also not a qualifying asset. Things are over. If you look properly, you took a loan of 320 and utilization is also of 320, friends. Okay, so 240 by 320. So what is the interest paid? 40 lakhs. So 40 lakhs into 240 by 320. This will be the amount that will be capitalized and remaining will be expense of. So friends, this much I think for our revision purpose more than enough. Yeah. So thank you very much and very all the best to all of you for your exams. Thank you.